Hello, this is Cynthia Fick, and this is the September 3rd stock market update. So we're now clearly into September, and I've been saying to buckle up your seatbelts because guess what? September is historically one of the worst months of the year for the stock market. So it'd been bumpy the last couple of weeks before we led into Labor Day. Very volatile. The market was getting a little defensive. 9 out of the last 10 months in general, the market has been up. And so again, we're just due for that bumpy ride. And I've said, hold on, you have to go through some of these turbulent times to get to your destination. And that's what I'm saying right now. Just a little reminder of what happens when the stock market starts feeling the effects of the Federal Reserve starting to lower interest rates. So if that does happen in September, like many are thinking that it will, here's again, just a little reminder of what happens to the stock market 1, 3, 6, 2 years down the line. Okay, I'm going to share a screen and show you what it looks like. Okay, so Matt had talked to you guys about what happens with the NASDAQ. I'm just going to focus on the S&P 500. Very broad base of the largest companies in the United States. So there's a slow lowering of interest rates that will happen, or there's a fast lowering of interest rates that can happen when the Federal Reserve really gets, it together and starts trying to stop the economy from going into recession. So I'm just going to lump them all together. And this is the S&P 500. When the Federal Reserve starts to lower interest rates, these are the last cycles that has happened. Some were fast, some were slow. I'm going to average them all together. Historically, after the Federal Reserve starts lowering interest rates, the next month, the stock market S&P is up 1.53%. In 3 months, the S&P 500 is up 5.54%. In 6 months, it's up 10.39. 1 year, 10.9, and 2 years, 24.91. That's all the goods, the bads. You see these, the red where the market was actually down. That's usually the times where we're going into recession. So they've just all been lumped in together, but it's generally, historically, the trend is up. And so that's, should be historically what we're expecting right now. So a bigger reminder of the long-term trend. Let me show you this again. These are those, 26, 27-year periods of time where we basically have an upturn in the market, secular bull markets, and we happen to be in one now. Sandwiched between those 26, 27-year periods of time, we have secular bear markets where the market trades down to sideways for 13, 14-year periods of time. I told you that's not aliens, that's not Stonehenge, anything like that. It's based on demographics. And it was based on the baby boomers before. Now it's based on the millennials and the Gen Zs. They're kind of back to back right there. So that's, again, the long-term trend. Here's when the last secular bull market started in 2009. And as you can see, if history repeats itself as it has done 3 times since 1933, this long-term bull trend will go on into the early 2030s. And again, based on history, and if something changes about that, we will let you know. That does not mean that we're not going to have, here's a 35% correction. Here was a 37% correction, believe it or not. So we're going to have ups and downs, but the general trend is up, and that's has not changed. So just a little reminder of why it's worthwhile to keep your seatbelt fastened and handle a little bit of turbulence, because we know the long-term destination of where we want to be. So that's all I have for you today, and we will talk to you next Tuesday. Have a good one. Bye.